I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today we're going to be talking about 2-1 buydowns.
The 2-1 buydown. That's a mouthful. 2-1 buydown. Are these points? Are they not points? Who can pay for them? Who can't pay for them? Let's get into it.
That's right. And remember, this is not financial advice. This is for informational purposes only. And if you're new to the channel, be sure to subscribe, comment, and like. I think the best way to do this is just show an example. All right. So this is a 2-1 buydown mortgage. There's a lot of people talking about it. A lot of banks are talking about it. Maybe your real estate agent has mentioned it, or a friend.
Mm-hmm. And can I interject this? Because Ed and I, we've talked a lot about this. And at first we were against it, weren't we?
Yes.
We thought of this program as a typical paying points to buy your rate down. This program has the word buy down in it. So that seemed very, very simple to connect the dots. But the reality is this is a totally different program than buying your rate down. And I just thought of it as we were.
Yeah, and we're going to get into like what that we basically discovered new information about the program.
Mm-hmm. And I'm also going to say this too. Think about this: a true paying points to buy your rate down is what we're going to call a permanent fix. Okay, this does not permanently fix anything, but it temporarily fixes that interest rate. So I'd like to set that aside and just say the real buy down is a permanent fix for the life of the loan. This is a temporary buy down.
So 2-1 buy down. What does an example look like? If you're purchasing a house and your loan amount is $400,000, and let's just say today's interest rates on a 30-year fix at the time of this recording are, let's just say 6.5%. That's the interest rate for a 30-year fix. A 2-1 buy down will take month 1 through 12. So the first year, your first year's effective interest rate would be 4.5%.
Right, which is your 2. It's going to be 2% lower.
Mm-hmm. And your monthly savings or the mortgage payment itself will be $501 less
than what it should be.
Yes. Okay. Now, between months 13 and 24, so the second year, now your rate adjusts to 5.5%,
which is the 1.
Mm-hmm. And you are your payment is $257 less than what it should be.
Right. So your first year, your payment's $501 lower, and your second year, it's $257 lower.
Yes, you can see right here where it says third. Right from year 33 to 30, your payment will be $2,528. That's your normal payment. Year 1, it's $2,026. Year 2 is $2,271. Okay, so you obviously can see that there are savings. This is a program, very important. At the very bottom left, you'll see seller would have to pay $9,103. This program requires the seller to contribute this to you as a home buyer.
Right, not the buyer. The buyer's not allowed to do this. And honestly, I don't know why the buyer's not allowed to do this, but that's just the way the rules are. Yeah. The seller has to contribute this money in order to do this temporary buy down.
Okay, yeah. And so I think that now we basically can ask the question, what is this program or who is this program for? And it's for borrowers who are very interest rate sensitive for at least the first 2 years of their loan. Because we've been talking about, the seller essentially offers the seller credit to the buyer. And this credit can be used, instead of paying closing costs and a normal buy down, they can buy down that interest rate for the first 2 years. This began where we're trying to make this distinction between a buy down and this permanent buy down and a 2-1 buy down.
Mm-hmm. Right. And we also talk about this as it relates to, this is very similar to what a borrower would do if they have issues having money beyond the down payment. If they needed help paying for closing costs and for the escrow account, they'd go to the seller and say, seller, give me a concession. Give me a credit. Is that credit free? No, a seller's only going to give you a concession if you in turn give them something. So if you're paying $400 for a house and you say, seller, give me $5,000, well, they're going to say, well, buy the house for $405,000 and I'll give you $5,000 in credit, netting the borrower or the seller the same amount. So the typical seller credit's used for paying closing costs and prepaids, but all of a sudden we're seeing this seller credit being used for that temporary buy down, which I think is so cool.
Yes.
So you either need seller credit to help with money to closing, or now you need help from the seller to help get that monthly payment lower for the first 2 years.
That's right. And so what's very different between this 2-1 buy down loan and a standard permanent buy down, like Puppy's paying points, is that this on the 2-1 buy down, this credit that the seller is giving you is going into essentially an escrow account. It's an account that the mortgage company is holding for you. It's not just paid and the invoice is paid and it's done.
Yeah, on a permanent buy down, it's gone. You pay the points and the next day that money's gone. This actually stays in escrow.
And this is the new information about the program that really makes it more attractive and it's because the seller gives you, for example, in this example that we showed here, which was $9,100.
And did we show our borrowers that the $9,100 comes from the $6,000 plus the $3,000? So you literally, it's here, dollar for dollar.
If you add basically what the savings has been.
Yep.
Or is year 1 and 2, it's the total.
Right. So instead of taking that seller credit and paying for closing costs, you're taking the seller credit, setting it aside and saying, seller, thank you for helping lower my monthly payment for those first couple of years. And for our first-time home buyers or buyers that are very rate sensitive, they love this.
Yeah. So what happens when the interest rates go down? Let's say you buy the house and then all of a sudden, 6 months later, 8 months later, interest rates fall, really go down. And now the borrower has the potential to refinance. That $9,100 that was in that account is going to be whatever's unused will be credited back to the borrower.
Credit back to the borrower. So that's another big difference between that permanent buy down, because it's gone day one, versus this temporary buy down. So if rates do fall, within 7 months, 8 months, 12, whatever it is, you didn't lose that money. You got the benefit of that money for however many months you made that payment. And when you refi to that lower rate, which we still think rates are going to be coming down, which is why this program is so great, you'll get that refund.
Yeah. So basically, if you refinance before the third year, between month 1 and 24, you're going to get a refund. Which is great, which is very different from a permanent buy down. So there are no gimmicks with this program. Again, when we originally were looking at the 2-1 buy down, we thought it was more of a gimmick loan. We did a podcast saying we didn't really like what we saw, but this is good information. In fact, a lot of lenders don't even know about it.
Right. And again, this is gimmick free, but there is one little asterisk here is just remember that seller credit is not free. Mm-hmm. In order for a seller to give you that credit, they're going to want something in return. So you either are paying $9,000 less for the house with no seller credit, or that seller is going to hold firm on his price and they're going to give you that $9,000 credit to use for this program. So it is accounted for, but it's just a way to keep that payment low.
Absolutely. It's a great point, and everyone should, if you want to kind of almost replay that again, because that is important right there about the seller. So again, if you're new to the channel, be sure to subscribe, comment, and like, and we'll be back.
All right. Thanks, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.